Hello and welcome to the Business Today show. I'm Udayan Mukherjee. My guest on the show today is a professor of corporate finance of impeccable reputation. But the distinction is that he's also very closely tracked by members of the financial fraternity because his core work, the work that he's very reputed for, is in the field of equity valuation, so much so that he's often referred to as the Dean of Valuation. And with so much going on in the world of corporate finance, particularly in global banking, it's a wonderful time to be able to welcome on the show Professor Aswath Damodaran of the Stern School of Business at NYU. Aswath, wonderful to have you on the show, and thank you very much for joining me today.
I'm delighted to be on. I don't know about the impeccable and the dean part, but I'm glad to be on anyway.
Thank you. This is such a strange time to be talking to you because, first it started off with Silicon Valley Bank, then Signature, and then Credit Suisse. And just when we thought it couldn't get even bigger than Credit Suisse, there are murmurs over the weekend about Deutsche Bank. Where is this script finally going to end, you think? What is the end game?
The problem with when you have a banking crisis is banks are built on trust. When I talk about banks, I think of them as the exact opposite of what you talk about when you talk about Bitcoin. Bitcoin I've described as a currency for the paranoid, by the paranoid, and essentially built on no trust at all. Banks at the other extreme are built entirely on trust. As an example, if we all decided to withdraw money from JP Morgan Chase, the largest bank in the world today, tomorrow there would be no bank left. So banks, because of that, it's very difficult to figure out where the trust comes back. So you can almost see the game play out. You get a weak bank, it gets knocked over, and the next target gets lined up almost immediately. So I think it will end. Let's hope it ends, because otherwise the end result is catastrophe. It will end, but it'll end in a time when, it's almost unpredictable when it ends. But it is going to play itself out, and eventually trust will come back, but there's going to be a lot of pain along the way.
Will there be a serious accident, Aswath, you think, by the time this ends? Or because the regulators know what the collapse of a single institution can do to the system, having seen it in 2008, they will do whatever it takes, throw whatever money it takes to prevent that from happening.
See, they can do that with a single institution. They can't do it with institutions collectively. The reality is the regulators put together do not have the resources to stop a complete bank run. And that's what I meant about this being unpredictable. If, in fact, the regulators were in control of the process, you could rest easier, but they're not. They have only partial control. They can do what they can to try to change the game. But the game here is to bring trust back. And that's no amount of money brings that back instantaneously. And unfortunately, I think we have a trust deficit. We've had a trust deficit for a decade or more. And I trace it back to 2008. I described 2008 as the year we lost trust. We lost trust in governments, we lost trust in regulators, we lost trust in banks, and that trust has never quite come back. So I think we're starting with a trust deficit to begin with, and with social media playing out the way it is, it becomes a lot more difficult to stop rumors from spreading and trust to come back.
That's exactly the point, because the trust deficit that you allude to, over the weekend, there's talk about Deutsche Bank. Now, we don't know whether Deutsche Bank is in a precarious position or not. They're saying they're not. But what's to stop people from going online and withdrawing their deposits anyway because of the rumors which are swirling around? Do you think that could actually lead to far greater damage than is warranted today in the banking space?
You can get into a debt spiral very quickly. I remember in November of 2008, when there was a very real chance that nothing would be left standing, when a rumor started that Morgan Stanley would not be around in a couple of weeks. And the rumor itself created enough trouble that Morgan Stanley actually was in trouble. So the perception that you're in trouble can actually create trouble. So at some point, there's got to be a point where trust comes back enough that people leave their money. So I think that's what the regulators and the governments are looking for, is some kind of a signal that this is not going to be an end run where everybody's got to take their money out. Because you've got to put your money somewhere. You can't leave it as cash under your mattress. So the money has to find its way somewhere. And that's going to be the question, is whether they can, and I'm not sure whether Deutsche will be left standing 2 weeks from now. My guess is it will, but let's see how it plays out.
I also read somewhere that the prudential norms in banking in the US are actually not making things easier, because apparently the bond losses of all the banks put together is very, very close to all the contingency reserves of the US banking system put together. Could that be even right?
I, I think what you're talking about is the fact that many of these banks hold long-term government bonds, which they bought in 2019, 2020, 2021.
Yeah.
And that's not just banks. Governments have significant holdings of U.S. treasuries. There's a markdown of about 18 to 20% because rates have risen. But that's neither here nor there. It's not, none of these banks need to sell those bonds to cash out right now to cover deposits. That's why I said it's a trust. It's a trust deficit. It's a deposit. If nobody had withdrawn money from Silicon Valley Bank, we wouldn't be talking about SVB right now as a bank that's shut down. So I think that the fact that there's $620 billion in potential losses waiting on the banks is neither here nor there. I mean, what made Silicon Valley Bank so unusual was that 60% of its assets were in treasury bonds and mortgage-backed securities. It was more hedge fund than bank. If, in contrast, if you look at a typical bank in the US, it's more like 20 to 25%. A typical bank in Europe, which also faces the same issue. Any market where rates have gone up, you're going to face this issue, has about 12 to 15%. So the magnitude of the bond holdings are much smaller at other banks. The worry you have, though, is if this banking crisis becomes a recession and the loans that these banks have start to fail, then you have a real problem on banks' hands, and that is a problem we don't want to face. And that's what the next step in this process is, to make sure this banking crisis doesn't become an economic crisis.
This is an interesting point, because that's the central issue today, Aswath, where a lot of people, economic historians included, have been suggesting that these bank failures typically happen just before an economy goes into, or at least the US economy goes into recession. Do you see that as a prelude or a harbinger of a recession to come?
There's been talk of a recession well before the bank failures, right? I've heard more talk of a recession in the last year than I've had in my entire 40 plus years in markets. So the amazing thing is, in spite of all of this talk of a recession, the economy has been remarkably resilient. Let's see if it's resilient enough to bounce back from this. But my guess is it adds one more chip against, the economy continuing to stay strong. You are going to see a weakness in the economy. Weakness by itself is not the issue. It's how deep the recession is and how much it might lead to losses on those loans that banks have on their portfolios. So I'm not quite ready to write the obituary of the U.S. economy yet. I think it is not a good sign if you think about what will the economy do over the next year. But it's not a fatalistic sign either.
Well, whatever's happening with deposits in the banks is one issue. The other is what's happening with stock prices of banks at large. I mean, since you track financial markets closely, do you think, if you were an investor, you would walk in and buy some of these banks today, or do you think there's far more damage to unfold?
Well, if you think that banking is still a service you will need 2, 3, 4, 5 years from now, which I think is absolutely the case, I think there are going to be winners and losers. This can't be all losers for all banks. So at the end of this, there are going to be banks left standing, and they're going to potentially be more valuable because they have larger market shares. For the moment, though, it looks like big banks are won at the expense of smaller banks. Money center banks are winning at the expense of regional banks. And because of the too big to fail, I think there is more deposit money flowing to bigger banks from smaller banks. So in the near term, the threat is to smaller regional banks, which might not be able to stand on their own. So my guess is you're also going to see a lot of consolidation in the bank business going forward, because it becomes increasingly non-viable to be a small bank with a clientele in a sector like Silicon Valley Bank. All of its clientele was in the Silicon Valley, the ecosystem, VCs, founders, startups. I think increasingly that type of bank is going to be under threat. So I wouldn't be surprised if coming out of this we ended up in a banking business that's dominated by 7 or 8 big players rather than the hundreds and hundreds of small banks that you see out there. And there is a loss to the economic system when you have smaller banks leave the system. Because when larger banks dominate, you have much more power in the hands of those banks in terms of setting rates. So let's see how this plays out. But I have a feeling that one of the things that is going to come out of this is a consolidation in the banking business.
Now, a lot of people have rushed to say that don't panic, this is not 2008. This is nowhere close to 2008. But you know, for people who've watched markets for a long time, they know that every crisis is different. I mean, it does not exactly mirror the previous crisis. So should we take comfort from the fact that regulators are aware of the problems of the nature of the previous crisis, and therefore we will not land up in the kind of mess that we did in 2008? Or could this crisis actually play a little differently but be no less damaging in a sense?
I think both statements can be true. You can take some comfort out of the fact that regulators have lived through something like this before and have the ammunition to deal with it. At the same time, you know that in every crisis, regulators say, don't worry, this is not the crisis, everything's going to be okay. So I think we need to be on high caution. And my suggestion is, you know, turn off CNBC, don't be so closely tracking markets every day, because in a sense there's nothing you can do to stop a banking crisis. Just take care of your own finances the best you can. And that might mean putting safety first, at least in the near term, if you're an investor who cares about protecting the principal in your portfolio.
How do you see the Fed moving right now? Because, you know, they were on course keeping inflation as their central target. I'm not saying they have abandoned it, but given the noise in the banking space, has their job become much more complicated in a sense? Could they now begin to think that their primary problem or the primary issue is to resolve the banking system and to get trust back into that system rather than fight the fire of inflation?
It really has made their job much more complicated, because in the near term you've got to stop the banking crisis. Because if there is a banking crisis, victories against inflation are going to be hollow, because I mean, what are you fighting for? The entire economy is being taken down by banks in trouble. So I think for the near term, I'm sure there's as much focus on the banking crisis as there is on inflation. But the Fed can't let inflation kind of not be taken care of, because if inflation keeps climbing, part of the reason banks are in trouble is because of inflation. I know people have said, well, banks are in trouble because the Fed has raised interest rates. The Fed did not raise interest rates. Inflation raised interest rates. The Fed chased interest rates up in the market. Inflation is at the source of the banking crisis. So these are not two separate problems. Inflation gave rise to the banking problem. And I think the Fed knows that. It knows that it needs to fix the banking problem, but it knows that there's a bigger source problem, which is inflation, and they need to take care of that as well.
Now, is this an American problem, Aswath, primarily? Because, you know, over the last few days, there have been lots of ripples and tremors across Europe as well. In India, most of the regulators have said so far that our system is different, our safeguards are different, and India is not in the same boat. Do you therefore see it as in a sense, a localized American problem, or does it have global ramifications?
It's less to do with geography than with parts of the world where interest rates have risen a lot. That's true in Europe and in the US. If you look at interest rates, the T-bond rate at the start of 2022 is 1.5%. At the end of 2022, it was 4%. In Europe, at the start of 2022, the Euro 10-year bond rate was close to 0%. By the end of 2022, it was at 2.5%. Any market where rates have gone up significantly is a market with a banking problem. And it's not just a banking problem, it's a problem with a lot of companies that have essentially mismatched durations, which companies do all the time, but these are the times when that mismatching comes back to haunt you. What saved Asia is not because the regulators are somehow more forward-looking and banks are more secure. It's because rates in India have not risen the way they have in the rest of the world, and that's true for a lot of Asia. So I think what separates the parts of the world that are not seeing a banking problem from the parts of the world that are seeing a banking problem is looking at what rates in that part of the world have done. And that's going to give you the answer.
Of the Indian banking system, I recently read one of your recent interviews where you spoke about the fact that the Adani Group had exposed the weakest links of the Indian financial system. But I don't know whether they were alluding to specific banks or insurance companies, but what were you trying to say?
I think this is no secret that if you go back in time, Indian banking and Indian family group companies have been linked at the hip, which is you loan to a family group and you don't do the due diligence that you would have done with an individual company, and not because you're corrupt, but because you assume the family will come through. And I think that's a very dangerous mechanism for lending. So I wasn't talking about any corruption or any inefficiencies per se in the Indian banking system. It's the close relationships between lenders and the businesses that they lend to, which can lead to being sloppy in your lending. So I think that that is a weak link in the Indian system. We know it's a weak link. It's led to some Indian banks having loans on their books to family groups that should be written down that haven't been written down yet. And this is a fight that's been going back to the days of Raghurajan at the, when he brought this problem up to the surface. It's not a problem that's gone away. And it's a problem that I think India has to deal with frontally if it wants to become the economic power that it aspires to be.
Do you see this as more of a public sector institution problem, or all all across? Because many of these group loans that you're talking about, or business group exposures that you're talking about, often end up in the hands of the lap of the public sector, whether it's the state-owned banks or the Life Insurance Corporation of India. Do you see a distinction there?
See, this is the problem with banks, is risks and losses are not separable. If State Bank of India goes down, guess what? It's not just State Bank of India going down, it's going to bring down the banking system. And look at Silicon Valley Bank, the 16th largest bank in the US. In the largest scheme of things, you're saying, who cares if the 16th largest company goes down? 16th largest technology goes down, you wouldn't even have noticed. 16th largest bank goes down, look at threatening to bring down the entire system. So unfortunately in banking, there's no such thing as separability. So if the big public sector banks have troubles, guess what? It's everybody's problem.
That is true. But we keep talking about loans and loans going bad and exposure for the banking system. The other thing is what is going on in the ecosystem of digital companies, the new age digital companies in India, where they too are growing, but they don't have recourse to bank debt. They take the money from private equity companies, and now there is a squeeze out there. How do you see that whole crisis playing out? Because the obvious starting point has been a huge amount of job losses in India as these companies curtail operations. But what's the end game in that story?
Well, two things. First is young companies should never borrow money. So not having access to bank debt is a good thing. Banks shouldn't be lending to young companies, because what are they going to pay it back with? So it's true you're at the mercy of venture capitalists, which I guess is the version of private equity that plays out here. But come easy, go easy. I mean, these are companies that came out of nowhere to be worth billions of dollars. And these are companies that will lose value. So why do we shed tears about this? This is the nature of the process. In the good times, you raise too much capital. In the bad times, you won't raise very much. It's healthy for the ecosystem, for the weakest of these companies to essentially be shaken out of the system. So I know it's painful in the near term, but I think it's healthier for an ecosystem not to have too much money sloshing around. And in my view, for a decade, we had too much risk capital funding these companies. And what happened in 2022 was a reversal to normalcy. It wasn't some retreat to some bad spot. It was just a reversal to what a normal risk capital market looks like. So I think in a sense, you might be shedding tears for the wrong companies. These young companies that raised too much capital went after traditional companies and regular businesses and ruined them. I mean, nobody shed tears for those disrupted companies. So why are we shedding tears for the disruptors now?
On hindsight, Ashwath, would you say that easy capital is the root of too many problems? I mean, we've seen it before. I mean, companies go through a cycle of 5 or 6 years where capital is abundant, risk capital, whether it's in form of debt or equity, and inevitably we'll land up in a major crisis. And the last 10 years, we know how that script has played out. In a sense, is abundance of capital a problem?
Absolutely. Everybody becomes lazy and sloppy. It's not just companies. It's investors, it's regulators, it's governments. Everybody thinks that the good times will last forever. And guess what? Through history, we've had these booms and busts. So in a sense, when we have a bust, people wring their hands and say, never again. But guess what? 10 years from now, there'll be a different boom and a different bust. It's almost like human beings are designed to repeat this process over and over again. We never learn, and we never will.
And we always, I mean, at least over the last 20 minutes, we've been talking about it from a corporate perspective. But is it the true of nations as well? Because, India's doing well economically, but we have a debt to GDP of more than 80%. I mean, we talk about the Adani Group and how it was unraveling because of excessive debt. At what point do we start worrying about nations which are doing quite well, but their debt is slowly beginning to get out of hand?
The thing about national debt is it's unlike corporate debt, where corporate debt you have no escape hatch, right? You default. National debt, your escape hatch is you print money. So your worry with national debt is not that nations will default, but that inflation will essentially be the consequence. So as long as you keep growing, as long as there's real growth, you can avoid that. But when the real growth slackens is when you start to see governments being tested. What are you going to do now about the deficits you're running? So I think it's an issue across the world is, as with markets, we've had a decade of excess where governments have spent trillions of dollars, especially around COVID. And now the bill is coming due. We've had a party, a really long party, and the hangover reflects how long the party lasted. So it's going to be painful getting out of it, but it's something that we almost have to do to get back to a healthier state of being.
My last question is the most difficult one, Aswath, which everybody's grappling with, because the last few weeks have raised fears of a 2008 kind of a situation again. Do you think we will get away lighter this time, or could we be staring at a crisis of that magnitude?
Could be is a weak word. Of course we could be. I don't think, in terms of probabilities, I don't think it's a high probability event, but there's definitely the chance it could happen. I mean, anybody who claims it cannot happen is lying. There's nothing in the system that can prevent a panic like we saw in 2008. But here's the good news. We did survive 2008 and we came out intact. It created an incredible amount of pain, but we got through that. So even if that is the outcome, you got to figure out a way of surviving the outcome and coming out on the other side. Because sometimes there are opportunities in the worst of threats, and that's something that I think we need to keep in mind.
On that optimistic note, I'll say thank you to you. It's been a pleasure talking to you, Aswath. Thank you very much for your time today.
Thank you for having me.